about $750,000.
Say that number one more time for the audience.
About $750,000, $750K, with some stuff we've done in the past week.
And how long have you been with Aaron now?
Not quite 60 days.
All right. So in less than 60 days, $750,000 in actual realized tax savings for your clients. And that's phenomenal, isn't it? Now, I'm going to just throw out a few things, Joe, a few nuggets, and see if you like any of these. A lot of times I compare the micro captives or the captives or the 831B strategies to the age-old idiom that people once called them. This is where you can start becoming your own banker. Some people are more familiar with that idea in regards to personally owned life insurance, and this is not to be confused with that. But the original term, become your own banker, by owning the bank, became more advantageous by owning an insurance company. And there's a number of reasons, and we won't go into all of those, but just as an example, think of Warren Buffett, who sold 3 banks and bought 2 insurance companies and increased his overall net worth by doing so. There's a reason for that. On a much smaller level, that's why the 831Bs are kind of like a small little subparagraph of insurance companies or the IRS code. They essentially allow business owners to take column A of their business, all right, so their income, their assets, and their growth, to take some of the money from column A and to put it into column B, their reinsurance company, their micro captive. By shifting the funds from column A to column B, they get a deduction as well as a deferral. All right, so in today's world of talking about tax strategies where it's all about deductions, deferrals, and exemptions, and how do we optimize those 3, this one touches on 2 of those. We essentially move money from our business, we pay it in the form of an insurance premium to column B, our insurance company, and we're able to stockpile that for a rainy day. We're banking it every single year. We're putting large amounts of money away so that we can save for business purposes for a rainy day in case of a business risk. Now, we're able to get access to those immediately should we have an insurance claim or should one of those rainy days actually happen. And it's a qualifying insured event. Should we not have one of those rainy days, we might be participating at a very small level in other people's insurance claims, which helps validate this strategy. But at the same time, we're saving up a large amount of money, which the shareholder of the insurance company can take out as a personal loan and invest back in his business, should he need to, or invest in other things. The insurance company itself, after year 1, may actually directly own and invest in non-liquid assets, such as real estate, such as more aggressive investments, including options, puts, calls, future contracts, or direct placement programs. Any number of these Reg D filed investments that are considered alternative investments, a captive reinsurance company can invest in those directly, or do a joint venture with its owner or other individuals, such as a syndication, to participate directly in assets that are not as volatile as the stock market. So there's a number of different ways that people can, 1, move assets from column A to column B, get a deduction and deferral, and then 2, optimize and recoup fees of the programs and make that asset grow by investing, as any and all insurance companies do. So micro captives and reinsurance companies, although abused by some, such as certain physician groups in the state of Oregon, have been known and have been a common strategy, so much so that most Fortune 500 companies participate in strategies very similar to this, even though it might be done at a bigger or higher level. The micro captives are a great option for companies that are making $700,000 or greater in gross revenues and have healthy margins. Another strategy, some people might be familiar with it as oftentimes called bulk minerals or charitable mineral strategy, where they get a deduction for putting money away, not only at the value that it costs them, but because the mineral has been processed, refined, and they participate in a partnership LLC in such a way that the holding period has been met, they are able to get a multiple, oftentimes 4 or greater times their original investment in the raw minerals. We do have a client that wants to do substantially more because they're a big fan of what's going on in Haiti with the foundation, and because they just want to know that they have future years income, at least up to that 30% limitation, also offset by something that they can do now because they have the cash now to do it. They have the cash to participate at the raw mineral level, and then that raw mineral gets processed and refined, packaged, appraised, and then donated to the charity. And so they're willing to supersede and donate more this year, knowing that they've got at least 5 years to absorb that deduction down the road. We just had somebody else call us today, and they were an individual that participated in magnesium last year, which was the mineral of choice. And this year, they just literally got off the phone with Micah, having questions if they can do it through a group. They have an employer group of like-kind business owners. And so there are scenarios where it makes sense to do it through an entity level rather than personally, but I would say 99% of our clients are doing this personally because it's a benefit that flows through on their personal tax return. On the restricted property trust, you can set it up in 5-year intervals, or if you just know that, hey, I want to do it for 7 years, you can set up the trust so that it automatically dissolves in 7 years, or at the 7-year mark, you can decide to reset it and extend it. There's a minimum funding of 5 years, because if you don't do that, then you put the life insurance policy or the asset of the trust at risk. And nobody wants to do that. And so there's a minimum obligation of 5 years to be funding the restricted property trust. Oftentimes we illustrate this for 10. Depending on the person's age, depending on their health, somewhere between year 8 and year 12 is optimal. We really have to run illustrations to find out what makes the most sense, where you have more asset there that can grow independently on its own than you actually spent in the funding of the asset. And that's based on insurance requirements, mortality rates, and a number of other factors that we help put together for you in an illustration. Usually takes something like this a day or two to run and effectively optimize, rather than other life insurance policies. You just plug in the numbers and in 20 minutes you've got something. This takes a little bit longer because we're really fine-tuning everything, putting in as much money as we possibly can, finding the optimal time period based on the employer's need for the deduction. Essentially, I don't want you to get this confused and just think that, hey, I'm funding life insurance. You are funding a retirement plan. This is a retirement plan, which is why you're able to get a deduction and be putting money away. The asset of the retirement plan has other tax favored aspects to it because it is a life insurance policy inside of the retirement plan. Now, it does make more sense to do this with a business that has year by year by year a healthy cash flow. If perhaps you're looking at this as a 1-year only strategy, a lot of times I tell clients that, hey, you know what, you're involving a third party. There's the third party provider that helps administrate this. You're involving us, you're involving the CPAs, you're involving a lot of people. You're going to pay a lot of people fees. And if you're only going to do it for 1 year, really, I don't know, even if you get a great benefit this year, does it make sense to involve everybody, pay everybody all these fees, and then not do it next year? There is the flexibility that all you have to do is pay the $6,000 every month for the tax return and for the renewal of the exemptions for the insurance company, so that it itself as an entity doesn't have to pay taxes. States don't really play in as much as the federal government does in regards to micro captives. Of course, if you got a deduction at the federal level that's being disallowed, the states jump in and want their piece of the pie too. But there isn't really one state that is more favorable than another state in specific terms of micro captives. There are some states that have some laws and rules that make businesses more favorable. I mean, some of these states that are just more friendly in general to businesses, such as Texas, Missouri, Nevada, Wyoming, some of these others, as an incentive, Florida even, so that more businesses can do business there and pay less in taxes, right? But specific to micro captives, there's really not one state that stands out as saying, hey, I'm more friendly to this strategy. They don't really come out and do that. Somebody was asking about audit protection. Audit protection. So the third-party provider that is our provider of choice, we've got two. We like two of them really, really well. But one of them stands out very distinctly because in their audit protection that they provide you as far as lifetime audit protection, they will step in. They, one, participate in the pool with you, which nobody else does. And two, should you receive an audit, they come in, they protect you. They currently have a 100% track record with the IRS with defending their clients that may receive notice letters or may receive queries from the IRS. Talk bad about them, but you got to make sure that you got the right provider based on your business size and based on the amount that you're contributing. And the least expensive in the industry is this, what I just mentioned, the $5,000 plus to get it set up, the $6,000 to get it, keep it maintained every year. All right. If you'd like more information, you can reach out to my office. There's an 800 number, 1-800-773-1848. There's a website. We actually have a few different websites, but for these tax strategies, it's strategictaxsolutions.com. You can go there and read more about it. You can also book an appointment there off of the website.